You ever look at a stock price and just think, is that really what it's worth? I mean, every single day the market gives us a price, right? But our job as investors is to be market detectives, to look past the obvious and uncover the true value that's hiding just beneath the surface. So let's grab our magnifying glass and get to it. You know, the legendary investor Benjamin Graham absolutely nailed it with this one. Price, well, that's just the sticker on the car. It's what you pay. But value, that's the engine, the engineering, how it feels to drive it. It's what you actually get. And believe me, those two things are almost never the same. Figuring out that difference, that's the real secret to investing. And that right there is the million-dollar question, isn't it? How do we tune out all that noise from the flashing price ticker and actually find the company's real fundamental value? Well, it turns out analysts don't have a crystal ball. They have a toolkit. To crack this case, we're going to look at three really powerful models. Think of each one as a different lens that helps us see a company's worth from a totally unique angle. Now, no single tool is going to be perfect, but when we use them together, we get a whole lot closer to the truth. Okay, so in our toolkit, we've got three main instruments. First up is the classic discounted cash flow, or DCF. That one tries to predict the future. Then there's the Olson residual income model, which looks at a company's value based on its accounting books. And finally, my personal favorite, a really clever twist on the classic, the reverse DCF. See, instead of guessing the future, this tool lets us read the market's mind right now, which makes it an absolutely crucial piece of our investigation. And this is where things get really, really interesting. The reverse DCF is a total game changer because it just flips the entire problem on its head. It lets us stop trying to be fortune tellers and instead lets us become market psychologists, analyzing what the collective hive mind actually believes today. So here's the fundamental difference. A normal DCF forces you to guess. You have to predict a company's growth years into the future. It's basically a shot in the dark. But a reverse DCF, it takes today's stock price and works backward to tell you the exact growth rate the market is expecting to justify that price. It turns a wild guess into a really sharp question. Is the market's belief actually realistic? And we're not just talking theory here. The data we're about to dive into comes from a massive analysis of over 2,000 US stocks. Every single one was put under the microscope using this reverse DCF approach. Okay, now what's wild about this chart is the first major clue it gives us. Just look at that big light blue slice. Almost a full third of all the companies we looked at couldn't even be modeled this way. Why? Because they don't generate any cash. They're actually burning it. That right there is a huge reality check. For the rest, you can see the valuations are all over the place, with a pretty big chunk sitting in what the model calls deep value. And here it is. This is the smoking gun. This table shows you the growth rate the market believes these huge companies have to achieve forever to justify their current prices. It's pretty stunning. The market is pricing Nvidia and Tesla as if they're going to grow their cash flows by over 10% every single year indefinitely. Now, compare that to a rock-solid company like Procter & Gamble, where the market is only expecting 1% growth. So this is really the heart of it all. We have to ask ourselves, is it realistic to expect a company, even a phenomenal company like Nvidia, to grow that fast forever? I mean, just think about it. No company in the history of the world has ever done that. And that is the power of the reverse DCF. It gives you a specific, concrete belief that you can challenge. Okay, so we've uncovered the clues. Now, how do we actually put them all together to build a solid investment case? How do you become the detective? Well, it's a systematic process. Here's the 4-step framework. First, you always start with that reverse DCF. Ask what growth is already baked into the price. Second, you check your margin of safety. Basically, how much can go wrong before you start losing money? Third, you cross-check with other models to see if they're all telling you the same story. And finally, and this is crucial, you validate with the fundamentals. Remember, a cheap stock with a terrible balance sheet isn't a bargain, it's a trap. And this is just a perfect example of why cross-check-in is so vital. For a company like United Health, both the cash flow model and the book value model are basically screaming undervalued. That's a really strong signal. But then you look at Disney and the models totally disagree. The DCF says it's fairly priced, but the other one shows a massive premium. So what gives? Well, Disney's true value is in things like Mickey Mouse and Star Wars, intangible assets that don't really show up on a balance sheet. The disagreement itself is the clue, telling you this is where you need to apply some human judgment. So, armed with this toolkit and this framework, you are officially ready to start your own investigation. The whole point isn't to get a single perfect number. but to approach the market with a brand new level of clarity. If you remember one thing from this, let it be this. Valuation modeling isn't some magic 8-ball that tells you the future. It's a tool for critical thinking. It helps you replace a vague gut feeling with a sharp, testable question, like, can this company really grow at 11% forever? And trust me, that is a much more powerful place to start. If you want to start your own investigation, you can actually find all of these tools, the reverse DCF, the residual income model, all those fundamental scores on fffinstill.com. That's fffinstill, FINSTILL.com. They've got over 300 free learning concepts just like this to help you sharpen your skills. And hey, be sure to follow us for more explainers like this one.
And that really brings us to our final question. You've now seen what the market believes about some of the world's biggest companies. You've seen the extreme optimism baked into some and the deep pessimism priced into others. So, the only question left for you, the detective, is, do you agree?